Welcome to Mortgage on My Mind, where we take the mystery out of mortgages and make dreams of home ownership a reality. I'm Natalie Salins, a top 1% mortgage broker with 20 years of experience, based right here in sunny Los Angeles. If you've ever wondered about pre-approvals, appraisals, or what loan product is right for you, don't worry, I've got Mortgage on My Mind, so you don't have to. Each week, I'll bring you expert advice, real-life stories, and insider tips to help you navigate California's competitive real estate market with confidence. Whether you're buying your first home, refinancing, or just curious about how it all works, this podcast is for you. So let's talk mortgages, demystify the process, and make your real estate goals a reality. Ready to get started? Let's dive in. Hello, everybody. Welcome to Mortgage on My Mind. Today, our guest, Jeff Scott, is a premier senior loan officer with Arbor Financial Group in Valencia, California. Interestingly, though, he is also an FHA DE underwriter with an extensive experience across sales and operations and underwriting. He has successfully navigated multiple market cycles. Today, Jeff utilizes his forensic knowledge of lending guidelines and advanced financial strategy to help families, luxury home buyers, and first-time buyers achieve their real estate goals across the state. Thank you for being on, Jeff. Hello, welcome.
Thank you, Natalie. I'm happy to be here.
Yes, so glad you could join. Looking forward to our conversation about FHA. It's something that I speak with most first-time home buyers about. There's a few things that buyers don't really understand, thinking that they have to be a first-time home buyer to qualify for FHA. There's like so many rules around FHA. They think it's a grant. They don't really understand what it means. And so I'm so happy to have an FHA underwriter on with us, also lender, which makes it definitely interesting. Why don't we start there? Why don't we start with what are the pros and cons of FHA?
Well, FHA was originally chartered back in the 1930s, and the entire emphasis of the FHA program, which is under Housing and Urban Development in the federal government, was to increase home ownership and to kind of democratize home ownership for the American people and get more people into owning their own homes. Because if you go back into the early 1900s, people either paid cash for a house or they put a tremendous down payment down, and it was difficult to find financing. And so FHA was chartered to kind of smooth the road out and make it possible for the average Joe to buy a home. And over the years, FHA has kept with that charter, and it is by far probably the most forgiving loan program, with the exception of the Veterans Administration, the VA loans. Forgiving loan program when it comes to debt to income ratios, when it comes to the down payment requirements. FHA's minimum down payment is 3.5%. FHA's debt to income ratio can go as high as 57%.
57.
Yeah.
Yes.
With actually 56.99, but that's splitting hairs a little bit. And so FHA really is one of the first things that we look at when we're dealing with a first-time home buyer and trying to figure out the pros and the cons of how long they're going to be in the home, what their credit scores are, et cetera, et cetera. But FHA is a wonderful program for a first-time home buyer.
But also for any home buyer, right? They don't have to be a first time.
100%.
That's where people get confused a little bit,
I've had multiple people that have purchased homes FHA for their first home, their second home, their third home. There are some restrictions within the program. If you currently own, a home and it's financed by FHA, and you're going to buy another one, there's a mileage restriction. You've got to buy, outside 100 miles of where your current home, if you're keeping it, is located. And so there are some reasons why people couldn't use an FHA, loan to buy a move-up property, for example. But there are plenty of other times where, people have owned homes in the past. And when we look at the numbers and how to best spend their money as far as down payment, closing costs, et cetera, FHA comes out on top. So there's absolutely no first-time buyer restriction.
Exactly. They can own 5 other homes
all with conventional loans and get an FHA loan.
Absolutely.
I think the main thing that people don't realize with FHA is a primary home purchase only.
Right.
So you cannot buy a second home or an investment home, of course, with FHA.
Right.
So it's not what I like to think of as a first-time home buyer program. It is an owner-occupied program. It is a program that you use only to purchase owner-occupied homes. And I've had clients do FHA home, like start in an FHA duplex, refinance them out into conventional, buy another FHA later, get out of it, get into another, like really be able to like use the system, as well as having clients who bought FHA years ago, kept the loan, turned it into an investment property, now live in a totally different city and able to use another FHA loan, even though the FHA loan that they had in the old city is still existing, but an investment property. So it's a fantastic loan for high risk buyers is what I normally say. So what do you have to cover risk? You have insurance to cover risk, right? Because FHA covers so much risk, you can have a 580 FICO score, zero money in the bank when we open, zero money in the bank when we close. It's crazy.
Right.
A ratio of 57, and we will still close this loan for you, but what comes with it is higher mortgage insurance.
Right.
So we do always say, like, that's a con of FHA. A con is that you have an upfront MI that gets financed. You don't come out of pocket with it, but it definitely adds close to 2% of your loan amount into the loan, which you don't have with conventional MI.
Right.
And then another main con is you can never get rid of the mortgage insurance.
Right.
And that's
until you refinance the property.
until you refi. Yeah.
Right. But as far as FHA goes, FHA rates are generally 3/4 of a point or so lower than conventional rates are. And so when you're financing that 1 3/4% mortgage insurance up front, after a 2-year period of time, you've saved 3/4 of a point per year on your interest rate. And so you hit a break-even point in year number 3 with a conventional loan, where you've saved back that mortgage insurance that you financed up front. And if you've got a credit score, let's say 660, which is perfectly acceptable to buy a home, but very expensive on the conventional mortgage insurance side, the FHA mortgage insurance, whether you have a 580 credit score or a 780 credit score, your monthly mortgage insurance payment on an FHA loan is exactly the same. And so the playing field is really leveled. So I've always looked at it as, if a borrower's credit score is below 700, we need to really take a close look at an FHA loan and compare it to what the conventional loan will be. If credit scores are well into the 700s, then conventional financing is probably the better way to go.
For sure. For sure. What made you want to become an underwriter, and specifically an FHA underwriter?
It was more out of necessity than it was, something that I aspired to. I've always been good with guidelines, but the company that I was working for at the time, back in 2009, we were kind of graduating up and going from being an FHA lender to being what they call a direct endorsement lender, which requires you to send test cases into HUD that have been underwritten, and HUD grades you on those test cases and determines whether or not your company, and specifically your underwriter, is enforcing their guidelines and underwriting things correctly. And we had hired an FHA underwriter to come in and be our FHA underwriter, and he just wasn't getting the job done. And the person at HUD who was reviewing our cases said to the owner of the company, you got to find somebody else, because this guy's just not getting it done. And so after we got off that phone call, the owner said to me, guidelines, let's make you the underwriter. You can take us through our test cases. And so I did, and we got our FHA, they call it full legal when you're a direct endorsement. And so that involved maybe underwriting 15 loans. And I enjoyed doing it. The thing that was interesting was, when you're a loan officer, you think any loan can get approved. and you'll fight for your borrowers, and
We see the compensating factors. Yes.
yeah, we see the compensating factor. When I put on that underwriting hat, it's a completely different thing. As soon as I open up that file and I'm now reviewing it from an underwriting standpoint, and it's not just will the borrowers qualify, but are they truly going to be able to afford that monthly payment? And are you looking at everything correctly? It didn't make me more conservative, but it made me more thorough. And so that was kind of the story of how I became an underwriter. And I was with that company another 7 or 8 years after we got our direct endorsement. And I would underwrite, on an overflow basis, 2 or 3 loans, a month. So I probably underwrote 150 or 200 loans. But, if I ever decided that I wanted to get out of origination and keep busy, I could go be an FHA underwriter someplace. And it really was fun. And it definitely made me better as a loan officer because it just made me that much more thorough.
Yeah. So you enjoy underwriting.
I enjoy numbers. I enjoy puzzles. One of the gifts that I've got is I've got a very good overview of any situation that I'm in, and that includes underwriting. So when I talk to a client, I'm always putting myself in their shoes and saying, okay, if I'm Natalie and Natalie's buying a home, and this is what her situation is, what's the best option for her? And I always want to. I tell my clients, I don't want you to ever go to a cocktail party and be talking to friends that just financed the home, whether it's a purchase or a refinance, and have them say, "Oh, well, we did this," because everybody's comparing notes. "Oh, we did this," and I don't want you to say, "Well, gosh, why didn't Jeff, talk to us about that? Because that sounds like a good option." And so I just enjoy the the part of pros and cons and educating borrowers, because for most people there really is a better solution for them than just here's your roast beef sandwich and it comes on white bread and that's the end of it. It's what are your plans. I'm talking to people, how long do you think you're going to be in the home? And they're like, well, dude, we haven't even bought the house yet and you're already asking us when we're going to leave. So, well, you need to think about those kind of things, and life is going to change. But if you can tell me what you think your plans are going to be, I can give you much better advice. And that advice saves people, or costs people, if they get the wrong advice, thousands and thousands of dollars.
That's why we work with the companies we do, right? We work with, for me, an IMB. For you, Arbor is a true brokerage, right?
We're both. We're a delegated correspondent, and so we're not underwriting, but we go prior approval, but we have warehouse lines. We fund our own loans and that. And so being a delegated correspondent, we've got a lot more control than being
Exactly.
direct broker. However, sometimes direct broker is the way to go. And if I show somebody our pricing engine, and they can see every option that we've got available, all of the different investors, all of we're shopping 150 different places. Now, we may only use 25 or 30 of them regularly, but I had a couple of oddball scenarios over the last couple of months that having, some of the brokerage options has been great.
Hmm. True. Yeah. I mean, we do all of it as well. It's kind of
Mhm.
like how IMBs work, right? We get to work with standard conventional, with, FHAs, VAs, tons of different non-QM, because we're also delegated with all of our non-QM. And then if there's, a really crazy condo that we can't get done, then we can broker it to
Right,
super non-QMs, is kind of what I call like the Lenshures and the Oak Trees and things like that.
right, right.
It's funny because going back to FHA, I was talking to clients today who are doing 7% down and they have perfect credit. The interest rate on conventional, because it's a high balance loan, is like 6.875
Mhm.
today. With FHA is 6.125. But when we ended up doing the numbers and the breakdown, so the payment itself ended up being like 400 less.
Mhm. On the FHA option?
the FHA option for the 6.1 as opposed to the 6.8. That's 400 less, but it's incredible because it's almost exact that the MI is 400 more on the FHA, right? So even with the close to 19,000 in upfront MI fee that gets financed, so now their loan amount is bigger. The FHA MI was 730. The conventional MI was 360. So the savings was only $40. And I had to say to them, I know that the FHA rate looks amazing for right now. You're only saving $40 to go FHA, but you're losing 19,000 in equity.
Right.
And if you want to think of it this way, the interest rate, while much higher, is also the part of the loan that you get to deduct. It's your tax write-off. So it is higher in mortgage interest, but it's also a better tax write-off for you. You can't really write off the MI.
Not in that tax bracket because you're going to exceed the 150,000 and it's going to cut off.
Exactly. Very much so. Yeah.
Did you look at the FHA arm?
No.
Because the FHA 5/1 arm is probably 5.5% or 5 3/8.
You're right. Yeah.
And I've put a number of buyers into that recently because the whole point is, we're not going to keep that FHA loan for more than hopefully 2 or 3 years because you're never going to get rid of the mortgage insurance. And so you bring that down, the rate down further because that FHA 5-year arm, because it's fixed for 5 years and then the most that it can adjust is 1% per year after that. If you're looking at 5 3/8 versus 6 7/8, you're going to be there for 5 years. Then you're going to go to 6 3/8. Then you're going to go to 7 3/8, worst case. And during that period of time, I bet if you did the principal calculation on 5 3/8 over 60 months, what your remaining balance is, and the 6 7/8 over 60 months, you probably have a $10,000 difference there. I mean, it's a huge difference on how much more principal balance the lower interest rate loans pay down.
Yeah, no, for sure. I mean, and that's only if they keep it for a long period of time.
Right.
Probably
Well, that's worst case.
Yeah, I'm
But
gonna
if you look at that, if you are actually a 1.5 lower, 5 3/8 versus 6 7/8,
possibly,
you're gonna get back the upfront MIP almost in the first year.
Right. Yeah.
So even if you only have it 2 years, you should be ahead of the game, but the tax deduction is going to be a little bit lower.
Right.
Although if they're high balance, they can only deduct the interest on the first 750,000, and it sounds like they're more in the 900 to $1 million range. Okay.
1.1.
Yeah.
Yeah. And the high balance arms also, I'm not sure if they're as low, but I'm going to check.
Yeah. Well, no, the standard the standard balance ones would be in the lower fives, but anyhow, that's just
okay. So how much do you do mostly FHA? Because now, no. Okay.
Hardly. I think I've done 3 FHA loans so far this year, and it's just I've got that as one of the things that that I do. But the majority of my business, I started out in the Antelope Valley, 41 years ago, and so all of my business was FHA and VA. And so that was what I really cut my teeth on. We've been in Santa Clarita for 29 years. And I would say when I first moved to Santa Clarita, maybe 20 or 30% of my business was FHA or VA. Now it's probably 2 or 3%. So it's, it's just not utilized in the loan balance ranges that we're in. And I know your loan amounts are the same or higher than mine are.
Right. Yeah. It's a tough, again, a lot of the time for me, unless it's really bad credit and the rate on conventionals in the 7s,
right?
Then a lot of the times my sensibility on it is you might as well do conventional, take the higher tax write-off and yada, yada, yada. But FHA has saved me FHA is saving me right now on condos because shockingly enough, because for all you listeners out there, FHA condos have to actually be approved by FHA. And it's a long and rigorous process to get a project approved for FHA. They ask for everything, everything, everything. But they have another system called a single unit approval, SUA, where you can get just a unit approved in a complex without having to get the entire complex approved. And they'll go up to a certain concentration of the project in order to do that. So a lot of the time, SUA is 10%.
Yeah.
And what's interesting right now in California, anyway, is that there is this thing called SB 326, which is inspections on balconies, and it is causing mayhem in the condo world because every condo that has an outdoor space that's shared basically has inspections that are due, and Fannie and Freddie are demanding that the inspections be done, and then they want the report, and then they want the repairs to be completed. Now, if you've ever worked with a condo team or an HOA management, getting repairs completed is incredibly difficult. So Fannie and Freddie has bumped up their unavailable projects in their system to an incredibly high amount, higher than ever. Are there condo projects that don't qualify anymore for Fannie and Freddie? FHA doesn't need inspections. They do not care about the SB 326. They won't ask for it. Whether it's been done, whether there's repairs that need to be done, they don't care. So it's this crazy, like, I've got somebody putting 20% down, and I'm like, well, do you want to go FHA?
Well, if you compare it to the non-QM options,
Right?
it's by far the better way to go, and the path of least resistance.
It's the path of least resistance because I can still close it in like 10 days rather than have to deal with an outside investor, you know.
And it's the one way that an owner occupant can actually, buy some of those condos, because the majority of them seem to be going to investors, at least in our area right now. When we're going to the non-QM, borrowers, either first-time home buyers or owner-occupant borrowers, a lot of time don't have the 15 or 20% to put down to get into the non-QM world as far as condo financing goes. So FHA is a huge help there.
Right. Exactly. So it's just an interesting turn of events where I used to tell people if they were first-time home buyers looking for a condo, not to consider FHA really, because it's so difficult to get that condo with FHA approved. And now I'm telling almost everyone, like, hey, this might need to go FHA. It's such an interesting thing. But, and that's the thing. FHA is difficult in some ways and easy in others. Like, they handle a lot of risk, but God forbid they allow a 1-year tax return. I mean, blows my mind what they want to see for income.
Yeah, it's more, straightforward. It's like the old school. Okay, you need 30 days of paycheck stubs, you need 2 years of W-2s, 2 years of tax returns if you're self-employed. That's just what their check boxes are.
You can't pay off a debt to less than 10 months. So if you have a car that's at 12 months remaining, you're not allowed to pay it to 10 months and not include the debt the way I can with every other investor.
Well, and that's one thing for you, potential home buyers that are watching this. That's why you want to talk to your mortgage lender 6 months in advance, and don't say, "Oh, honey, we're going to go buy a house this weekend. We better, find out about financing," because if you're 6 months away, we can look at your credit report and say, you know what, let's pay the balance down on this auto loan, and then you're fine. But yeah, it's the last minute guys that run into difficulty. One thing that we are seeing about our condos is the homeowners associations have traditionally been unhelpful or unorganized in helping us to get a condo project fully approved, rather than doing the single unit to get a condo project fully approved. And now they're coming around, and we're starting to see more cooperation from them, because FHA changed the rules 15 years ago and required all of their condo projects that had been approved for years to get reapproved. And a lot of HOAs cooperated at that point because they wanted the FHA approval because we were going through the mortgage crisis, and they wanted to add value to their projects. For the last
Right.
15 years, things have been selling so quickly that the homeowners associations didn't need to cooperate. And now that the market has slowed down a little bit, and now that we're having financing issues with condo projects, now they're kind of knocking on our door again and saying, hey, do you know how to help us get, FHA approved? And, as you said, it's a long process and it requires a ton of documentation. But if you get a project approved, it
It's
increases
huge.
values in that project dramatically.
100%. To not have to go non-QM. I mean, my condo projects that now are having to switch out from Fannie and into non-QM, every single unit is losing 10% of its value because now they have to get a higher interest rate to
Right.
get the condo. Sellers are dropping out. They're putting it on the market for rent while the inspections and repairs are being done.
Right.
Like it's kind of been a real issue in the past year because it is 100% lowering condo values.
Mhm.
It's you can't sell it as a standard. You can't offer a normal rate on a condo.
Right.
Then the value is worth less.
Right. Well, and that's what, I've always told people, and this is one thing that Zillow, is pretty accurate on, is if you go onto a Zillow site and you look up a property address and you see the last time that property sold, and you figure, okay, Southern California, let's add 4%, per year as far as value goes. If you go back 25, 30 years and you look at the ups and downs in real estate prices, the bottom line is still, if I bought a home in 2000 and it's 2026 right now, it's probably gone from $390,000 at the time of purchase to about $1,100,000, right now, and that's about 4% per year. And you've got that up and down in there. If you go and
Right.
you look at the same thing on a condo, you'll see that 4% pretty consistently from the early 2000s to about 2019. And then since that time, it levels off or it has dropped a little bit. So condos will
Right.
be a good value again at some point, but there's a lot of regulatory things that need to be worked out in order for them to be a good investment again.
Yeah, totally. Totally. Well, thank you so much. This was lovely chatting with you.
Oh, you're welcome. I enjoyed it.
Thank you for informing all of our listeners on the FHA pros and cons. It's an incredible program, truly. For also a pro, really quickly, it just occurred to me, is that FHA is the only program that allows 3.5% down, or even less than like 5 or 10 or 15% on duplexes.
Right.
So any of my clients that don't have more than, let's say, 5% down and they want to buy a duplex to help with their monthly payment, FHA allows duplexes 3.5% down to like over 1.5 this year. It's in the same interest rate. They don't hit the interest rate for it being a 2-unit. That to me is an unbelievable deal. I always say that FHA on duplexes is kind of the only way to go. Even it's like amazing. Yeah.
As long as they're going to live there. The last thing that I would say as far as FHA goes, and I just thought of it, is you said earlier that FHA will allow your credit score to go down to 580 and still have a 3.5% down payment. Well, right now we're going through one of those periods where people have more debt than ever. People have more equity in their homes than ever if they're currently homeowners. But a lot of people have been hurt from a credit standpoint, over the last couple of years. And they're really running on fumes as far as feeling like their financial life is put together properly. Well, FHA will allow you to go all the way down to a 500 credit score on a cash out refinance, where if you've got equity in your home and you've got a pile of debt that you don't know how to resolve, you don't want to necessarily, Dave Ramsey would say, oh no, you're never going to take debt from your home, equity from your home and pay off bad debt. But I've had borrowers, I had one guy, and this was probably 10 years ago or so, 502 credit score, owned a home in Simi Valley. It was worth about $700,000. He owed about $300,000. He had $200,000 in terrible debt, but his income was fine. And we took $200,000 cash out on the property, paid off all of his bills. I talked to him a couple of weeks ago. said it was the best thing he ever did, and they've been on kind of the financial straight and narrow since then. But that's the one thing that people, I don't think, realize as far as what we do. We're faced with these kind of stories all the time.
Yes.
We've got solutions for them. And, the internet is great and it has educated a lot of people, but the information that you're getting out is only as good as the information that they've programmed in there. You take somebody like, me being in the business for as long as I have, all I've got is just old stories and, old solutions. And when somebody, oh yeah, I did that for the Smiths back in, 2006, and
Right.
the same solutions work. So it's, talk to a mortgage professional.
Exactly. Well, fine words to end on. Thank you again.
You're welcome, Natalie.
Everybody, I hope you enjoyed this. It was truly informative. You need to know and understand your options 100% when you are looking to purchase. And Jeff, thank you for your expertise and seasoning and wise words. I appreciate it.
Yeah. Seasoning, that's the good word.
That is, right? Taste. Okay.
Okay.
All right, everybody. We'll see you on the next one. And thank you for joining. Bye.
Okay. Thank you.
Thanks for listening to Mortgage on My Mind. If you're ready to start your mortgage journey or have any questions, I'd love to help. With 20 years of experience, I make the process as simple and stress-free as possible. Check the show notes for my contact info, and don't forget to subscribe, leave a review, and share this podcast. Until next time, I'm Natalie Salins, here to help make your real estate dreams a reality.